Using the right retirement account the wrong way can cost you way more than you think. Most people worry about whether they've saved enough for retirement, but the account you use can affect how much gets taxed, when you're allowed to touch the money, and what you actually keep. Let's start with the account most people think they already understand.
401k. Most workers think this is just the retirement account their employer gives them. But a 401k is actually 3 decisions stacked on top of each other. First, are you getting the match? Second, are you choosing traditional or Roth? And third, what happens to the account when you leave the job? Start with the match. If your employer matches a percentage of what you put in and you are not contributing enough to get the full match, you are leaving compensation behind. That part is not complicated tax planning. It is simply compensation you do not want to miss. The match is not the only part, it is the starting point. So, the simple way to use a 401k is this. First, try not to miss the match. That is the part your employer is offering on top of your paycheck. After that, the question becomes tax timing. Do you want the tax break now, or do you want more flexibility later? That is where the traditional versus Roth choice begins. Traditional means the contribution goes in before tax. You may lower your taxable income today, but withdrawals later are generally taxed as ordinary income. This means you simply delay the tax bill. Roth works the other way. The contribution goes in after tax. You do not get the deduction today, but qualified withdrawals later, including the growth, may not be taxed again. Neither one is better by default. Traditional can make more sense if your tax rate today is higher than you expect it to be in retirement. Roth can make more sense if you expect the opposite. Many people choose one without understanding which situation they are in. Then here comes the third decision. What happens when you leave the job? When you change employers, the old 401k usually stays behind. And old accounts scattered across former jobs do not manage themselves. You may be able to roll the money into a new plan or an IRA. You may also decide to leave it where it is. But ignoring it for years is not a good call. So the way to use a 401k is not just to contribute and forget it. Use it first for the match. Then use it for the tax treatment that fits your situation. And when you leave the job, make an intentional decision about where that money belongs. And this is exactly why retirement accounts are worth understanding before money starts moving. The expensive part is usually not the account type. It is the rules you didn't know attached to it.
Subscribe if you want more of these rules explained in plain English before they become expensive.
Now, a 401k depends on your employer. But once the account is yours to open, the next question changes. Are you getting a tax deduction or just assuming you are? Traditional IRA. Traditional IRA is a personal retirement account. You open it yourself through a brokerage or financial institution. No employer required. And the assumption many people have is simple. If I contribute, I get a tax deduction. That assumption is not always right. Contributing and deducting are not the same thing. Whether your traditional IRA contribution is deductible depends on your income and whether you or your spouse are already covered by a retirement plan at work. Picture someone who contributes to a traditional IRA expecting a tax break on this year's return. They have 401k at work. Their income puts them above the deduction phase-out range. Money went in. The account exists, the investment is still there, but the deduction they expected is reduced or could be gone entirely. That creates a second problem. If part of the contribution was non-deductible, you need to track that correctly. Otherwise, when you take withdrawals later, the IRS may treat more of that money as taxable than it should be. And proving that later is on you, not the IRS. That tracking is called basis. It shows which part of the money was already taxed. So when does a traditional IRA make sense? In plain English, it is most useful when it gives you one of two things: a real tax deduction today, or a clean place to move old retirement money. If the deduction is real and useful, the traditional IRA can help lower taxable income now. If you are rolling over money from an old workplace plan, it can also give you more control over where the money is invested. But if it gives you neither, then you need to be careful. You may still be saving for retirement, but you may not be getting the tax benefit you thought you were getting. So the key rule is this: a traditional IRA only solves today's tax problem if the deduction shows up. If the traditional IRA is about trying to lower taxes now, the Roth IRA flips the deal completely. That sounds better until you realize Roth is not free. It is prepaid tax. Roth IRA. A Roth account is not automatically better. It just works differently. That distinction is important because the word tax-free makes a lot of people stop asking questions. Roth money is not money that was never taxed. It is money where the tax was usually paid upfront. You contribute after-tax dollars. You gave up the deduction today. In exchange, qualified withdrawals later, including the growth, may come out without owing income tax again. That can be powerful. But it is still a trade. You are making a bet that paying tax at today's rate is worth more than taking the deduction now and paying tax later. For a younger worker with a modest income, that trade can make sense. Their tax rate today may be lower than the rate they face later, especially if the account has decades to grow. For someone in a peak income year, closer to retirement, the math may look different. If they need the deduction today, paying full tax now just because Roth sounds better is not automatically smart. The simple way to use a Roth is to think of it as your future tax-controlled account. It can be useful when your income is lower, when you have many years for the money to grow, or when you want a pool of retirement money that may not raise your taxable income later. That can matter in retirement, because not every dollar coming out of every account is treated the same way. Traditional withdrawals can add to taxable income. Qualified Roth withdrawals may not. That difference can give you more control later. But if you are in a very high tax year and badly need the deduction today, Roth may not be the automatic winner. A few rules matter here. Income limits apply to direct Roth IRA contributions. Above a certain income range, the ability to contribute directly phases out. There are legal ways around that, but they come with their own conditions. And Roth has another rule that catches people: the 5-year rule. Contributions and earnings are treated differently when money comes out. That can surprise people who open a Roth later in life and assume the tax-free treatment is immediate. The Roth IRA also has one important planning advantage: no required minimum distributions for the original owner during their lifetime. That gives it flexibility that traditional accounts do not have, especially for people who want to let money grow longer, manage taxable income later, or leave the account to a beneficiary. So a Roth account is not magic. It simply changes when you pay the tax. You pay now because you believe the future treatment will be worth it. So far, these accounts are mostly about retirement income. But one of the biggest retirement costs is not income at all. It is healthcare. And that is one of the most overlooked accounts in retirement planning. HSA, Health Savings Account. The HSA is the account many people ignore because it has the word health in the name instead of retirement. That is the first mistake. To open one, you need to be covered by a qualifying high-deductible health plan. But if you qualify, the tax structure is hard to beat. Contributions can be deductible or pre-tax. Growth inside the account can be tax-free. And withdrawals for qualified medical expenses can also be tax-free. Doctors, prescriptions, dental, vision, some long-term care premiums. The list is longer than many people realize. That combination is rare, and it is why the HSA deserves more attention than it gets. Most people use an HSA like a medical checking account. A bill comes in, the money goes out, the balance stays near zero. That is not wrong, but it misses the bigger opportunity. Used casually, an HSA pays this year's doctor bill. Used strategically, it can become a retirement healthcare account. So, the more powerful version is this: pay today's medical bills out of pocket if you can afford it. Leave the HSA invested. Let it grow. Then, by the time you reach retirement, when healthcare is often one of the largest and least predictable expenses, you may have a dedicated account built specifically for those costs. Money went in with a tax advantage. It grew tax-free. And if used for qualified medical expenses, it can come out tax-free too. That is how you use an HSA at its highest level. Not just as a debit card for this year's copay, but as a long-term healthcare account for the costs that are probably coming anyway. There are 2 mistakes to avoid. First, spending the balance every year and never letting it grow. Second, contributing after enrolling in Medicare. Once you are on Medicare, HSA contributions generally are not allowed. Contributing anyway can trigger a tax penalty, and many people do not see that coming. After 65, non-medical withdrawals avoid the 20% penalty, but they are still taxed as ordinary income. At that point, for non-medical spending, the HSA behaves more like a traditional IRA. The real power of an HSA is for medical use. And in retirement, you should be planning for those expenses. Healthcare is one special case. Your job can create another. If you work in education, healthcare, nonprofits, or government, your plan may look familiar, but the rules may not be. 403B and 457B. These two accounts often get pushed into the same public worker category. That is convenient, but it can lead to expensive assumptions. A 403B is common for teachers, school employees, hospital workers, and nonprofit employees. It works a lot like a 401k. Contributions come through payroll. Traditional and sometimes Roth options may be available. Employer contributions may also exist. On the surface, it feels familiar. The issue is often the investment options. Some 403B plans are loaded with annuity products, high fees, surrender charges, or limited choices. The account works, the payroll deduction works, but the cost structure can affect the balance of your retirement portfolio for years. The problem is not that it is a 403B, but not every 403B account is built the same way. So, the question you should be asking is, what am I actually invested in? What am I paying? And can I leave without surrender charges? The money may come out of your paycheck automatically, but that doesn't mean the plan itself is good. The 457B is where the rules can change in a way that actually matters, especially after you leave the job. A governmental 457B, often used by state and local government workers, may allow withdrawals after you left your job without the standard 10% early withdrawal penalty. That can be helpful if someone leaves public service before 59 and a half. This can act like a bridge account. If you retire at 55, but most of your retirement money is locked behind age rules, the 457B may help cover the years before other accounts are easier to access. That can be extremely useful for certain public workers who retire earlier than private sector workers. But not every 457B works the same way. Non-governmental plans, which may be available to some nonprofit employees, can be more restrictive. For example, you may not be able to roll the money wherever you want when you leave. The plan may require distributions on a certain schedule, or limit when and how you can access the money. Two people can both say, I have a 457B, but one may have a flexible bridge account, while the other may have an account with restrictive employer rules they did not expect. Same account, different risk profile. The most important question is not just, do I have a 457 account? It is, what kind of 457 do I have, and what happens when I leave? That one question can change how you use the account. For the right public worker, a governmental 457B can be an early retirement bridge. For the wrong plan, especially some non-governmental versions, it may come with restrictions that are more complicated than people realize. And if the employer is the federal government, the account changes again. It looks familiar from the outside, but inside, it has its own system. TSP, Thrift Savings Plan. For federal employees and military members, the Workplace Retirement Account is the TSP. It is useful because it is simple and low cost. But when a plan feels simple, it is easy to stop paying attention. That is where mistakes can creep in. The fund lineup is intentionally small, G, F, C, S, I, and life cycle funds that blend them by target date. The expense ratios have historically been very low. Over 20 or 30 years, that cost advantage can matter a lot. But low cost does not automatically mean good planning. The G fund is where many federal workers end up, either by default or by choice. It is built for stability, not big growth. Over long periods, it may not grow enough to keep up with inflation and rising retirement costs. For someone with 15 or 20 years still ahead, sitting entirely in the G fund may not be conservative planning. It may be trading long-term growth for short-term comfort. Traditional TSP contributions are pre-tax. Roth TSP contributions are after-tax. Agency contributions and matching depend on which federal benefit system you are under. Another decision comes when federal workers leave service. A common reflex is to roll everything out of the TSP into an IRA. That may make sense in some cases, but it is worth pausing first. The TSP's low costs, simple structure, and certain withdrawal features may still be useful. An IRA may offer more flexibility, but it may also come with higher costs or more ways to make mistakes. There is no automatic winner. The point is to compare before transferring the money. Don't treat your TSP as something you automatically leave or roll over. Use it as a low-cost base, then ask whether an IRA actually gives you something better. More investment choices. Better withdrawal flexibility. better estate planning, or a clearer income strategy? If the answer is no, transferring the money into an IRA may create more complexity. The TSP is not perfect, but for many federal workers, it can be a strong foundation. The mistake is either ignoring it completely or rolling it over just because IRAs sound more sophisticated. But not everyone has an employer plan. If you work for yourself, you do not just choose an account. You choose the business structure behind the account. SEP IRA, Solo 401k, Simple IRA. Self-employed people and small business owners have several retirement plan options, and they are not interchangeable. The SEP is usually the simple one. The Solo 401k is usually the flexible one. The Simple IRA is usually the small employer one. Start with the SEP IRA. This is where many solo operators start because it is easy to open and easy to run. Contributions go in on the employer side. When you are self-employed, that means you are contributing as your own employer. It can allow relatively high contributions as a percentage of net self-employment income. But here is where it can get expensive. If you have eligible employees, you generally have to contribute for them at the same percentage you contribute for yourself. Put in 20% for yourself, and that obligation may apply to every eligible employee. That math changes quickly as the business grows. The Solo 401k works differently. This is usually for self-employed people who do not have full-time employees, other than possibly a spouse. The advantage is that you can contribute in two ways, part as the worker and part as the business owner. That can give some self-employed people more room to save than a SEP IRA at the same income level. Some Solo 401k plans may also offer a Roth option, depending on how the plan is set up. But the trade-off is paperwork. As the account gets larger, the rules and filing requirements can become more time-consuming. Then there is the Simple IRA. Think of this as the easier small business plan. It is often used by employers who want workers to contribute through payroll, but do not want to set up a full 401k. The employer does have to contribute, and one rule catches people. If money comes out during the first 2 years of participation, the penalty can be steeper than the standard early withdrawal penalty. These plans are not one size fits all. The right choice depends on your business. Are you working alone? Do you have employees? Do you want the easiest setup? Or are you trying to save as much as possible? If you are solo and want simple, the SEP IRA may be enough. If you are solo and want more contribution flexibility, the Solo 401k may give you more room. If you have employees and want something easier than a full 401k, the Simple IRA may fit better. The point is that the account should match the business. Not every self-employed person needs the same plan, and not every small business is ready for the same level of administration. Simplicity, contribution room, employee payroll. Those are the real differences. And then there is the retirement benefit that does not work like any account we have talked about. You do not just decide how to invest it. You may decide what income your household gets for life. Pension. Every account before this one is something you build, manage, and eventually draw down. A pension is different from all of it. It is a defined benefit plan. The employer keeps the promise. When you retire, there is no account balance you control and no investment options to choose from. There is usually a monthly payment for life based on your years of service, salary history, and the plan formula. Pensions still exist. Government workers, teachers, firefighters, police officers, military members, union workers. Many people, 50 and above, still have one. If you are in that group, the account balance is not the decision, it is the election choice. Most pensions require a choice before retirement. A single life payout usually gives you the highest monthly income. But when you die, the payment stops. A joint and survivor option usually pays less each month but may continue paying your spouse after you are gone. The biggest monthly check can be the weakest household plan. If you or your spouse has a pension, you shouldn't chase the highest check, but think about what income is left if one spouse lives another 10, 15, or 20 years alone. A surviving spouse who loses pension income may have very little left to work with, especially if Social Security and savings do not close the gap. A few $100s more each month may seem like a better deal upfront, but if that choice leaves the surviving spouse with no pension income later, That is not a good deal for the family. Lump sum offers create a different problem. The number looks large, but taking it means managing risks yourself. How long you live, how the investments perform, and whether you can turn that lump sum into income for the rest of your life. That is not always the wrong trade, but it needs skills and careful planning for it to work. Pension income is generally taxed as ordinary income when received, and the election is not just about what you get each month. It is about what your household keeps and for how long. The account you use does not just affect how much you save. It can affect what retirement income costs you later. Think of your retirement accounts like different buckets. Some buckets lower taxes today, but create taxable income later. Some do not give you the deduction now, but may give you more control later. And one bucket, the HSA, is strongest when it is used for healthcare. Traditional withdrawals from accounts like 401ks. Traditional IRAs and pensions are generally taxed as ordinary income. In retirement, that income can stack on top of Social Security, rental income, and other taxable sources. When the total crosses certain thresholds, more of your Social Security benefit can become taxable. Required minimum distributions can also push income higher than you planned, and Medicare premiums can rise based on income reported 2 years earlier. But qualified Roth withdrawals and HSA withdrawals used for medical expenses behave differently. They generally do not show up as taxable income in the same way. That difference can affect Social Security taxation, Medicare premiums, and the overall tax picture in retirement. The real retirement question is not only, where should I save? It is also, what happens when I need to use the money? Don't choose a retirement account just because it sounds familiar or popular. Choose it based on what you need that account to do. Employer money. Tax relief today. Tax-free qualified income later. Healthcare costs. Business owner savings. Lifetime pension income. Those are the real decisions underneath each account. That is how you use retirement accounts well. You do not need to know every technical detail. You just need to understand what each account is meant to do and where the wrong choice can cost you later. If this helped you sort out what these accounts are actually for, send it to someone who has a 401k, IRA, HSA, or pension, but still is not sure how the rules work. That is exactly who this was made for. I'm Allison. I read the fine print so you don't have to. I'll see you in the next one.